In this session, let's look at the multinational operations, where I mean a company doing transactions with the companies in other countries. So buying and selling of the goods in other countries, that is one aspect of multinational operation. Two, having subsidiaries in the other countries. So in these two cases, how does a company account these kind of transactions? How is it treated in the balance sheet, and how are these transactions treated in the income statement, and how do you translate from one currency to other currency? What are the exchange rates involved in this process? All these things are typically packaged as a part of this session. So from the accounting standpoint, before we actually take up an example to convert one company's financial one currency designated financial statements into the other currency designated, or even in this chapter we would also be looking out for what if the subsidiary is a part of an inflationary economy. All these things would be looked at. So before I get started, the first thing I would like to look at is what kind of currencies, what do we mean, different kinds of currencies which we typically talk of. So we categorize the currencies into three major groups. One is a local currency, which is let's say an Indian company. So for an Indian company, the local currency is Indian rupees. Now, the Indian company can typically do its business, means buying and selling to either Indian customers or outside customers, but for the sake of its regular trading, dealing in businesses and all, it may use either Indian rupee for regular transactions, or it may say I'll use US dollar for my transaction purposes. So when a country is using dollar for transaction purposes, we say that it is not using the local currency, or in either of the cases, whatever is the currency that a particular company is using for regular transactional purposes is what we call as a functional currency. It may be same as the local currency, may be different from the local currency, doesn't matter. But most of the business dealings happen in this currency. So probably even if an Indian company says, yeah, I will sell you this good for $50 US, rather than saying the selling price for this good is 3,000 rupees, it may say the selling price of this good is $50 US. The country may be still in India, but for the regular transaction purposes, it is using US dollar as the currency. So generally, if a particular company, for all its transaction purposes, even for the wages to the employees, or for material buying, or for any such kinds, to a large extent, if it is using one particular currency, we call that currency as a functional currency. And which currency to use as a functional currency is completely determined by the management of that particular company. And the third kind of currency which we talk of is the presentation currency. That is this currency in which the financial statements are prepared at the end of the year. The currency, it may be local currency, if at all this company is incorporated or registered in India, then probably it may prepare in the local currency, or sometimes it may prepare in some outside currency also. So all these are the different kinds of currencies which we talk about, and we'll use these different currencies when we are thinking of restating the financial statements or re-preparing the financial statements from one currency to the other. Now, as I said, there are two major aspects that we are going to look at as a part of this multinational operations. One is the typical day-to-day transactions in the foreign currency. The second is having a subsidiary in the foreign country. So when I talk about typical day-to-day operations or transactions in the foreign currency, from a company's standpoint, if at all it is dealing, let's say an Indian company is dealing with a US company for regular buy-sell operations. Now, it is designating the product in US dollars. Let's say the presentation currency is still Indian rupees. The foreign financial statements are still prepared in Indian rupees. So, whenever a deal is done, whenever a sale is done in US dollars, on that date of sale, an entry goes into the financial statement as per the exchange rate on the date of the transaction. So let's say I have, as an Indian company, I have sold something in US for $50, and let's say on that date of sale the exchange rate is 60 rupees per dollar, which means on that date it gets into my financial statement saying a sale was made for rupees 3,000 bucks. If I receive that 3,000 or $50 on that particular day itself, nothing to worry of. But otherwise, the sale, as per the revenues, I will recognize 3,000 rupees. And because a credit was given, accounts receivables also will show 3,000 rupees. On the day the transaction was done, irrespective of whether the payment was received or not. Now, on the day when I receive the money, the US company will still pay $50 only. The US buyer will still pay $50 only. But depending on the exchange rate at that time, means if the exchange rate has become 61 per dollar, actually the Indian company is going to receive 3,050 bucks. And because of that, it can represent a gain. It can represent a gain of 50 rupees on the day it has received the money. So the account receivable will go up, and because it has received 3,050 in the form of cash, the 50 will go as a foreign currency gain. So when the foreign currency is appreciating, especially in case of sell transaction, when the foreign currency is appreciating, you will see that the local currency will gain